The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very happy Friday to you all. Welcome to Squawk Box Europe with Juliana Tattlebaum and Steve Sedgwick. And these are your headlines. The Trump administration's pressure on Fed Governor Lisa Cook intensifies as she faces another criminal referral over her mortgages.
Buyer beware, online shopping gets more complicated as President Trump ends a century-old tax loophole, placing up to 50% tariffs on imports worth less than $800. And European nations start the clock on sanctions, giving Iran 30 days to make concessions over its nuclear program or face sweeping reinstated measures, sparking anger in Tehran.
Good morning.
Very good morning.
How are you?
I'm doing well.
Did you have a good night's sleep? You look very vibrant, ready to go.
I would say a short night's sleep. We don't get too much with this show, but I'm doing well.
Good, excellent. Now, I, needless to say, did get a good night's sleep. That's why I'm buzzing this morning.
When aren't you buzzing?
Oh, bless you. The dexterity needed, both verbally and indeed politically, to be a responsible FOMC member on one hand, and at the same time apply for a job that requires you to kind of, how do I say it, have a different kind of approach to monetary policy. The dexterity is enormous and way beyond many of us mere mortals. But I have to say, Mr. Waller, in the last 24 hours, has walked across the Niagara Falls on the tightrope beautifully because he's got the headline that he wanted. Jumbo rate cut. That's the headline that everyone's going with. Waller, jumbo rate cut. But actually, if you look at what he said, he is so towing the line with what's actually the orthodoxy at the moment. He's saying, look, at the moment, and I think I'm paraphrasing the Fed member correctly, you'll correct me if I'm wrong, and I'll come to the read in a moment. At the moment, yeah, it's only 25 basis points in September, absolutely. But if everything goes really bad in the labour market, then yeah, I could go for a jumbo cut as well. So, how can I put it politely? Yeah. If things get really bad and the data, which we're all data driven, changes, then you will change your mind. And so that's kind of where everyone else is coming from. But he got his headline out there, jumbo. Did the president see it? Did the president see what I said?
I have to say, I totally agree with you. When I saw the headline, I thought, wow, he's calling for a jumbo rate cut. That's pretty explicit. That's going pretty bold. And then when you actually read into the detail, he's not calling for that as his base case. I think what's playing into the hands of Waller and anybody else who supports a rate cut in September is that at this point, you could build a credible case for a need to cut rates. Beyond that, it clearly becomes a lot murkier, and it's not necessarily easy to build a credible case. But at this point, you can sort of toe the line and be okay.
He's done well. He's got to the other side on the tightrope. Well done, Mr. Waller. Anyway, let's go through what he said. He said he expects the central bank to cut rates in September, with more to come over the following 3 to 6 months. Waller, who is said to be on the President Trump's list of Fed chair candidates, it changes a lot. Sometimes it contracts, sometimes it expands, but he's said to be on the list. Said macroeconomic conditions were deteriorating, and it was important that the Fed does not fall behind the curve. Waller said he does not currently see a need for a bigger 50 basis point move lower next month, but that could change if the August jobs report comes in weak. Meanwhile, the Fed Governor Lisa Cook is now facing another criminal referral from the Trump administration. Federal Housing Finance Agency Director Bill Pulte has filed a new criminal referral with the Department of Justice, alleging misrepresentations about a third property in Cambridge, Massachusetts. It comes as Cook fights to block President Trump from firing her. The first hearing in Cook's lawsuit will take place in D.C. later today. Speaking to our US colleagues, the former Cleveland Fed President Loretta Mester said President Trump's push to remove Cook from her position was worrying.
This is bigger than just going after one governor, Governor Cook. This is really about trying to influence who's on the board before the terms of those officials are up. I think we're in a situation where if it's true that a president can remove someone based on an allegation an accusation without any facts, then we've lost Fed independence.
Let's get a look at U.S. markets and how Wall Street fared yesterday. More gains for all three of the major indices. They all ended the session higher. The tech-heavy Nasdaq gained about 0.5%. The S&P 500 0.3% higher. This was the third positive session in a row for all the major indices. S&P 500 closing at another record high, the first ever close, in fact, over that 6,500 level. The Dow also posted a record close. And in terms of sector trade, 7 out of 11 sectors were positive in the session, led by communication services, which gained about 1%. On the downside, utilities was the laggard, losing about 0.9%. We've also been tracking bond markets quite closely. We have seen a sell-off in the long end of the curve. Recently, investors increasing their bets that we will see rates come down over the short term, but rise in the long term, given the inflation outlook. Right now, we are looking at a 10-year yield around 4.217%, and then out further into the curve, you got the 30-year trading around 4.89%. In terms of the dollar, here's where things stand right now as we close out the month of August. We are looking at euro trading on the back foot versus the dollar. Sterling also weaker versus the greenback. Dollar yen not doing a whole lot, and dollar Swissy slightly firmer on the morning.
Ladies and gentlemen, thank you. Sorry. Ladies and gentlemen, I've already been dissed off camera by my lovely colleague because she says watching ultra running is so dull. Well, I disagree. And this weekend, I don't know if you all know, it's the World Championship pretty much. It's the UTMB. It's in Chamonix as well. So what do you get if you mix Kilian Jornet with Heidi? Max Kettner is Chief Multi-Asset Strategist at HSBC. It's only because your notes tell me you're in the mountains, so I thought I'd play on that. Max, for a start, looks lovely. Are you on holiday?
I am indeed. Good morning. Good morning, Steve.
Oh, lovely you could join us from holiday. Well, thank you very much indeed. Look, I'm going to get back to more serious matters. Mind you, I don't know if there is anything more serious and more exciting than UTMB, but I will go with it. Tell me what you think about the current state of US employment and whether it justifies more than 25 basis points of cuts in September.
No, I don't think it actually does. And I do disagree with the notion that really we're seeing this sort of dramatic slowdown in economic activity in the US. In fact, when we look at high frequency indicators, particularly also on the labor market, it's not just consumption, it's not just manufacturing, but also on the labor market. Look at the American Staffers Association. They've got this weekly staffing index that's been going up the last 8 weeks. Jobless claims, it's the same sort of thing, right? We've seen them go up in May and June, and then really since the end of June, they've been trending lower. And I would say that also expands to other parts of the economy. When we look at the Dallas Fed, for example, the Dallas Fed runs this aggregate weekly activity index that also has been really troughing around the end of June and has been picking up ever since. We also see that on the consumer side of things, same store retail sales are going up. Credit card data is going up. So really some consumer spending proxies have been picking up in the last 2 months. So there is actually, I would say, really a bit of a risk of a re-acceleration, particularly against very, very depressed consensus expectations for the third quarter as a whole and also for the second half in the row. And I would also say, when we look at investment, bear in mind, investment has been almost subtracting a full percentage point of GDP in Q2, and consensus is expecting no comeback of business investment in the third or fourth quarter, given trade tensions. But I would also say, yes, perhaps we are going to see some reversal of front-loaded activity, but we also got to be fair and say, look, if we do have a little bit more clarity on the trade side of things, if we have a bit less economic policy uncertainty, shouldn't then also some business uncertainty business uncertainty going down, and that means business investment coming back? All of that really argues against this sort of big jumbo cut.
Well, Max, just to throw into the mix, we did get some revisions around that GDP data. U.S. business investment in the second quarter actually stronger than initially thought. I guess playing into what you're saying here, that actually the U.S. economy, U.S. fundamentals are still in pretty good shape. But on the flip side, is it fair to say that you could build a credible case for a September cut? Perhaps not further out, but is there, if we do see the Fed coalesce around this idea of cutting rates in September, would it be considered a policy mistake at this point, or is there still some credibility to backing a cut?
No, I think there is some credibility. Clearly, inflation is no longer as high as it was perhaps a year ago. Clearly, we are sort of stuck at the 3%-ish line. There are some worrying signs, I think, around inflation. They're not worrying as they were, well, as worrying as they were in 2021 and 2022. It's not looking as if, underlying measures of inflation go to 4 or 5%. They're still stuck sort of around 3%. I think the worrying thing that I have around inflation is that it's not just goods inflation and not just the distribution of goods inflation that's been going up in the last 2 months, but also other services inflation components, right? There's this really famous super core inflation that the Fed came up with after, during this transitory inflation episode in 2021 and 2022. That also has been going up in July. So there are some worrying signs. They're not as worrying, though, I think it was, as they were in 2021, 2022. So does that mean rates can go from 4.5 down to 4.25 or maybe even 4% in December? Sure. Does that mean we can cut below 3%, below what the Fed is considering as neutral by the end of next year? Absolutely not. That, I think, is really overdone. So those 5.5 cuts that are priced in by the end of next year, that is too much. That should be much closer to sort of 2.5 to 3 rate cuts, given how strong actually the economy continues to be.
Max, when it comes to markets, we've got PCE data coming out a little bit later on. Then next week, we've got the U.S. non-farm payrolls data. And given the backdrop that you just outlined for the Federal Reserve, what kind of paradigm are we in? Are we in a weak data is good for equity markets paradigm, or a weak data is bad for equity markets because of what it would signal about the strength of the U.S. economy?
So I'm going to be a classic economist and say it depends. I would say, if it's weaker data but not too weak, right? It depends how weak it is. If it's sort of the weak-ish data, I think the market will take that really, really well, because let's face it, we have the level of short-term rates is 4.5%. So the good thing is we can cut pretty dramatically, right? So if things really do deteriorate faster, fine, then we'll get a higher probability of a 50 basis point rate cut. And that is still really then quite good for risk assets overall, whether that's for credit spreads, whether that's for EM, whether that's for equities. I think it really depends whether, if you've got payrolls going all the way down to like minus 100,000, then I think really it will be not taken as a positive, because that, of course, will then say, well, you might as well cut 50 now, but you're too late. You missed the mark. You missed really the point where to cut and where to sort of save the economy. I don't think we're at that level at all, though, because, again, some of that high frequency data pretty consistently across the board has been showing some signs of pickup in the last 2 months. And the other thing that I would say on the labor market, bear in mind that given the reversal of immigration flows that we've had in the last sort of 6-7 months, the break-even payroll number, so the number of payrolls that we need to see in order to keep the unemployment rate unchanged, that break-even payroll number is very likely going to be much, much lower compared to what it was 2021 until 2023. So that means even if we get like a 60, 70, 80K number, that might actually be enough to keep the unemployment rate not only steady, but actually send the unemployment rate already lower. And that then really throws a lot of those hopes around a jumbo cut or those 5.5 cuts in the price until next year. That calls it really into question then.
Max, I'm going to ask 2 questions in one. What has been your biggest winning trade? And I know you've done incredibly well this year. What is your biggest winning trade so far this year? And what is your biggest bet for your biggest winning trade for the rest of the year? Because I know you're enthusiastic about a whole host of things: equities, high yield credit, EM rates, EM equities. What have you made your most money on, or has been your best call? And what do you think is going to be your best call going forward?
So we've been overweight pretty consistently since the start of the year in an emerging market local rates. I would say a lot of that has been driven by emerging market FX, by the depreciation of the dollar. That, I think, is largely over. It doesn't mean that the dollar is going to come back, but probably sort of sideways. It's going to stay weak, but it's not going to go massively weaker. That, however, given how high real rates in emerging markets are, that's still good enough for emerging market local rates to work. It's not going to be as great as in the first half. So that means, to your second question, I think it's much more about the US. It's a comeback of the US. It's, going back into US high yield, going back into US equities. And I do think, particularly when you look at the 10-year, when you look at rates at treasuries, I don't think that, treasuries are really priced correctly for any sort of re-acceleration of growth, particularly against those depressed consensus expectations. Let's bear in mind, when I talk about re-acceleration, it doesn't mean that, we're going to get suddenly like 4% GDP growth. But if you've only got sub 1% annualized consensus GDP expectations, a sort of boring 2% number is already a massive upside surprise. That means equal weight S&P should really start to perform quite well. So a bit of broadening in equities, and particularly the treasury side, I don't think really is priced for those upside surprises relative to those depressed consensus expectations.
Fabulous. Thank you very much indeed. Lovely to see you. And look, I've just worked out you're actually in the wrong end of the Alps. You need to get down to Chamonix. You've got 294 kilometres to do. You can get there for the start of the main event, the UTMB, which I know that Juliana is so excited about. Max, have a lovely rest of your holiday, and thanks for breaking holiday to join us. Max is Chief Multi-Asset Strategist at HSBC.
Do they actually televise this event?
No, you can find it on various YouTube channels. but one of your countrymen has just nailed the 61k race.
61k?
Yeah.
Wow.
Jim Walmsley. He's awesome.
Wow.
He's awesome.
Well, I can't say that
He's
I'll
a
be tuning
superstar,
in
and you've
this
never
weekend.
heard of him, have you? You should. Seriously, everyone, Google Jim Walmsley. He is a super athlete, one of the best in the world.
Oh, thank you for the tip. All right, we are going to take a break. We'll dive into the winners and losers as the U.S. ends its century-old de minimis rule, plus Iran slams European nations as they trigger a snapback process, which could see the reinstatement of sanctions. We'll discuss, and we'll be joined by the former CFTC chairman to discuss all things crypto. That conversation later this hour.
So there's no doubt about it. The US is primarily sitting or leading the economic agenda when it comes to global trade and tariffs. I think we can all agree with that at the moment as well. It's the president who is setting the pace. And how other massive nations, let alone the smaller nations like Great Britain, deal with it, or massive trading blocs deal with it, is quite extraordinary. Do they form alliances? Do they bury the hatchet on old issues? It's fascinating. And when I'm talking about these big nations, I guess I pivot to Asia, and I think about India, I think about Japan, I think about China. So at the moment, those nations meeting, it's phenomenally interesting to know what they are doing about the country that is setting the pace and the agenda. I think we all can agree on that, can't we? So the Indian Prime Minister, Narendra Modi, is actually visiting Japan in the first leg of a tour that will also see him not only talk to the leaders of China, but also of Russia. Now, the visit comes at a key time for both countries as higher US tariffs and a changing geopolitical landscape threaten to disrupt global alliances. Kaori and Joji, of course, is amazing on everything Japanese and joins us now from Tokyo. And Kaori, I think it's going to be fascinating how the Japanese leadership publicly portray the meeting with Mr. Modi, because, of course, historically, Japan is stunningly close to the United States, but now is being kind of not hung out to dry, but is being kind of like grouped with a lot of other nations that haven't been traditionally so close.
Yeah, exactly, Steve. I mean, traditional friends are sometimes turning into foes and vice versa. So I think the agenda is very, very broad when the Prime Minister of India, Narendra Modi, meets with the Japanese Prime Minister Shigeru Ishiba. And the stakes are high because both of these countries are at loggerheads with the United States. I mean, Japan has acquiesced in many cases to the United States, and all of them are looking to forge new partnerships to try and cushion the blow from this new economic reality that we're in. I think there are two things in particular that I'm focusing on as a result of this 2-day trip. One is security cooperation. And this is where it gets tricky because Modi is heading to China right after this trip. But Japan has been saying time and time again that it is concerned that China is asserting itself in the Indo-Pacific. And there are expectations that the security cooperation between India and China that has been in place for 17 years, that might be revised as a result of this summit meeting later on tonight. The second, of course, is the economic agenda. And I think there are two sectors in particular that I'm watching out for. once this red carpet welcome tonight and the bilateral summit and the working dinner is through, on Saturday, the two leaders are going up north to the northern prefecture of Miyagi Prefecture. And there's two things important about this trip. One is that they're taking the Shinkansen, which is the bullet train. I mean, China has panda diplomacy. Japan has Shinkansen diplomacy. They've already agreed to sell some of that technology to India, but you're going to be riding that train to show them that, yes, you're going to China, but look, don't forget about Japan. We have technology that we can offer as well. Once they get there to Miyagi Prefecture, there's a high concentration of chip equipment manufacturers in that region, and there's talk that they might be touring some of those facilities. So we all know the supply chain disruptions that could be triggered when some of these key components, there's a lag and there's a stoppage on those components, like we saw with rare earth earlier on this year. So I think those are some of the two areas that could be revised as a result of this summit. And I think thirdly, it's not going to seem significant monetarily, but I think we're going to see more commitment to sort of grassroots back and forth between China and India. There's actually a pretty big Indian community here in Japan, and most of it is in the IT sector. But as you know, the population in Japan is declining. It is aging. They need workers, and India is the most populous country in the world. And I think Japan is keen to have more workers come here, particularly to help in areas like nursing care. So there might be some development on that as well. And so this is Modi's 8th visit to Japan, but I think the dynamics surrounding his trip this time around are significantly different.
Carrie, so interesting to think about what these two countries can offer each other right now. In particular, what you were just talking about there around how Japan can really potentially lean into utilizing Indian workers, especially in the tech sector. Talk to us about the context of this meeting happening just weeks after the Trump administration announced and has now imposed these higher tariffs on India. Clearly, Prime Minister Modi is looking for ways to cushion the blow of those tariffs. What might we expect from an investment perspective from Japan into India, and how that is impacting his approach to these conversations in Japan this weekend?
Yeah. I mean, India has made it clear that it's going to dig in and it's going to fight with these trade negotiations with the U.S. I think there are key areas that you should look at. And I think one of them is artificial intelligence. The other, I think, is pharmaceuticals, perhaps, because India is a huge market for that. And clean energy, I think they're going the other way. Japan is fairly keen to export some of the clean energy as well. And overall, in relation to the security issues in the region, shipping technology is re-emerging as an area that Japan wants to tout, to say that, look, you have naval ships, we can help service them in times of need. So I think those are the kinds of areas that the two could see eye to eye on. And don't forget, these are two heads of state, but they'll be meeting with the private sector as well. And as you know, chip equipment companies have been investing here very heavily. The auto sector, I mean, basically Suzuki, the Japanese auto company, basically made the Indian auto segment. So I think those are some of the areas where we can see some progress between the two nations.
Brilliant work, as ever. I know we've got to let you go now, so thank you for joining us, Kaori, and always a pleasure listening to your excellent reports. Kaori and Joji in Tokyo. And for more on what is at stake when Prime Minister Modi continues his tour with a crucial meeting, really, with China's President Xi, check out CNBC.com. Juliana, I can't think of saying the words de minimis without saying it in a song-like fashion. De minimis. I don't know. Everyone else like that, or is that just me?
I would say out of the two of us, it's just you.
Okay.
The U.S. has ended its century-old de minimis exemption as an executive order from President Donald Trump takes effect, closing a trade loophole for international shipments of low-value packages almost 2 years early. The exemption closed for China and Hong Kong back in May, ending for the rest of the world today. Now, the practice had seen imports under the value of $800 enter the states virtually duty-free, a threshold sharply higher than the likes of the European Union and the UK, and over 57 times greater than that of Canada in approximate dollar value. So what are the potential impacts? Well, U.S. consumers may see delays in shipping and higher costs, with parcels subject to the tariff rate faced by their country of origin, or a flat rate of between $80 and $200 offered to National Postal Services for the next 6 months. Now, National Postal Services in multiple countries, including the UK, Japan, France, and Germany, have paused shipments to the U.S. amid questions surrounding the new rules. The British Chambers of Commerce drew a comparison with Brexit, warning of disruption from new trade barriers and urging a quick response. The outlook for low-value shipments is appearing increasingly more expensive, with not just the U.S. eyeing changes to exemptions. The U.K. is currently reviewing its £135 de minimis rule, with the European Union also mulling an end to its €150 threshold. CNBC's Courtney Reagan filed this report looking at the potential winners and losers from the end of de minimis.
We're at Cart.com's Florence, New Jersey fulfillment center. The third-party logistics provider stands to benefit as the de minimis exemption expires, because retailers using the de minimis exemption to ship are now turning to U.S.-based third-party logistics partners to fulfill those under $800 orders. Cart.com accepts goods made all over the world and then fulfills for brands like Janie and Jack, Hatch, Adidas, Guess, Bare Minerals, and others. It just signed 2 new clients and says more are interested as the de minimis loophole closes. Many brands utilizing the de minimis exemption often use warehouses in Mexico, in some cases Canada. Then trucks make daily milk runs, driving pallets of shrink-wrapped merchandise to shipping facilities built for this reason just across the border.
These brands were taking advantage of a 30 to 40% cost arbitrage by shipping out of Mexico, and then on top of that getting another 25% arbitrage because of customs and duties, and that made it worth for them to ship out product 1 to 2 days later and pay the extra cost in shipping because they're now zone skipping, right? But as these brands now come to the U.S., the cost of operations is going to be higher.
Tapestry says the elimination of the de minimis exemption will have about a 20-cent drag on earnings for fiscal 2026. Barclays estimates around 14% of Tapestry's total sales will go from paying 0 tariffs to 30%, and says Lululemon will be impacted too. Direct-to-consumer apparel company Ministry of Supply has been spending the last 6 months transitioning its supply chain in preparation of the de minimis expiration. And CEO Ayman Advani tells me other retailers are panicking. They use de minimis because it's safe, legal, common, routine, and smart. Courtney Reagan, CNBC Business News.